Hey everyone, and welcome to The Explainer. Today, we're going to pop the hood on corporate finance. We're going to figure out what really makes a company strong and what might just be a ticking time bomb hiding in plain sight.
You see it all the time in the headlines, right? A company's stock is just blasting off. And the assumption is, wow, they must be doing great. But is that really the whole story? Does that high-flying stock price actually guarantee that the company is built on solid ground? I mean, think about that for a second. A company that looks totally invincible from the outside could actually be scrambling to pay its bills. That's exactly why we need better tools. Kind of like a financial x-ray to see what's really going on beneath the surface. Okay, so let's get right into it. To get that true picture, we have to look past the flashy stock market numbers and really dig into a company's ability to just survive day to day. And this all boils down to one really important idea, and that idea is liquidity. Put simply, it just asks, can the company pay the bills that are coming due soon? A great way to think about it is like a financial first aid kit. How well stocked is it? Is it ready for those little unexpected financial scrapes and bruises? So, how do we actually measure this financial first aid kit? Well, the first tool we're going to look at gives us a quick, top-level checkup on a company's immediate health. And this is the current ratio. It's usually the first place an analyst looks. The formula is pretty simple. You just take a company's current assets, so stuff it can turn into cash within a year, and you divide that by its current liabilities, which are basically all the bills it has to pay within that same year. So let's break down what's actually in that mix. On the asset side, you've got the obvious stuff like cash, but you also have things like accounts receivable. That's money customers owe them. And, this is the important one, their inventory. On the other side, the liabilities, you've got your bills from suppliers, any short-term loans, that kind of thing. Now, the general rule of thumb is that if the number is over 1, that sounds good, right? It means you have more assets than you have bills. On paper, it looks like the company's totally fine. But here's where it gets a little tricky. And this is the big catch with the current ratio. What if a huge chunk of those assets is just a warehouse full of stuff that isn't selling? You can't pay the electricity bill with a pile of last year's unsold phones. And that's exactly why we need a much stricter test. So this brings us to a more, let's say, intense set of tools. If that first ratio was like a basic checkup, these next ones are more like a full-on financial stress test. The very next step is something called the quick ratio, or as it's sometimes called, the acid test. Sounds serious, right? And for good reason. The key difference here is that it completely removes inventory from the calculation. It asks a much tougher question. Okay, if we can't sell any of our product, can we still pay our bills? But believe it or not, we can get even stricter. Let's push it to the absolute limit with the cash ratio. So the quick ratio still includes money that customers owe the company. The cash ratio says, nope, get rid of that too. It strips everything away except for pure, hard cash. It answers the ultimate doomsday question. If every single creditor demanded payment right now, this very second, could we do it? Okay, let's look at this from a totally different angle for a second. Instead of just looking at the assets a company has sitting around, the operating cash flow ratio looks at the cash the company is generating from its core business, from actually selling its stuff. Then it compares that cash flow to its bills. This tells us if the business engine itself is healthy enough to pay its own way. All right, so we've put the company's short-term health under a microscope. Now let's zoom all the way out and talk about how the world actually values the company as a whole. And we're going to start with the number you probably see the most. And that number is market capitalization, or just market cap. You can think of this as the company's public sticker price. You just take all the shares of the company that exist and multiply them by the current stock price. It's basically a snapshot of what the public thinks the company is worth on any given day. But, and this is a huge but, the sticker price is not the real price. Looking only at market cap is like seeing a beautiful house for sale and not bothering to ask if there's a giant mortgage that comes with it. It tells you absolutely nothing about the company's debt. And that leads us to our final and maybe the most powerful metric of all. If you wanted to understand the true cost to walk in and buy the entire company, lock, stock, and barrel, This is the number you'd need to look at. And that number is enterprise value. It gives you the full story. You start with the market cap, but then you add all of the company's debt because, hey, if you buy the company, that debt becomes your problem. But then you get to subtract all its cash because you could use that cash to immediately pay off some of that debt. That's the real all-in takeover price.
So there you have it. After that quick tour, you've now got a powerful set of tools, your own financial X-ray machine, to look right past those distracting headlines.
Let's just quickly recap this new toolkit. You've got the current ratio for that initial broad checkup. Then you have the quick and cash ratios for a much stricter stress test. You've got the operating cash flow ratio to check the health of the actual business engine. And when you're looking at value, you now know to look beyond the simple sticker price of market cap to the much more complete enterprise value. And that really brings us to the most important point of all. No single number ever tells the whole story. A smart analyst, kind of like a good doctor, would never rely on just one test result. They use a whole suite of tools to get a complete and accurate picture of health. So, I'll leave you with this question. The next time you see a headline screaming about a company's soaring stock price, what are you gonna look for? Which one of these tools will you want to grab to see what's really going on under the surface? Thanks for watching The Explainer.